So this is the question, right? A client seeking advice on her fixed income portfolio observes the price and yield to maturity uh, of 1 year and 2 year annual coupon government benchmark bonds currently available in the market. Which of the following statement best describes how the analyst can determine a break-even reinvestment rate in 1 year's time to help decide whether to invest now for 1 or 2 years? Okay. Uh, as as the 2 year rate involves intermediate cash flows, divide the square root. This will not be right. Since the first year's returns are compounded in the second year, set 1 plus R1 multiplied by 1 plus the break even. Yeah, this is the answer, right? Because this is, if this is 1 year spot rate. Okay, this is 1 year spot rate. 1 plus, let's say this is 5%. And then plus 1 plus break even reinvestment rate. So this is for the second year. This one or this one? 1 minute. No, even this is not right. This one, since the break-even reinvestment involves a zero coupon cash flows, first substitute 1 year R1 into 2 year bond price equation to solve for the 2 year spot or zero. Yeah, so this one into 1 plus break-even reinvestment. So break-even reinvestment is this one, R2, you can say. Okay, this interest. Okay, that means this part. So this part is suppose 5% and 2 year. So this is 1 plus Z2 raised to 2 means 2 year zero coupon bond. Okay, Z1 means 1 year. So this is spot they have mentioned as 1 plus R1. Fine. If this is, let's say, 6%, 6%. Okay. So this is the given conditions. Now this is called as my reinvestment rate. So if this is 100 rupees and if it is compounding first year for 5%. Okay, first of all, how will I calculate this part? It will be 1 plus 6% raised to 2 divided by 1 plus 5% raised to 1 minus 1. Just calculate how much it comes to 1 year forward rate 1 year from now.
$7.009.
7.009. Okay. 7.009. So this will come to 105. Now further, if it goes to 7.009%, how much is it coming to?
Sorry.
How much is this coming to? 105 into 1 plus 7.009%.
This is 1.1235.
What 1 point? This is 105, no?
Oh, sorry.
112.35.
112.35. Similarly, here also, if I invest 100, 6% for 2 years, check, it should come to the same amount.
Yeah, 112.36.
Okay. Now, this is, so that's why this is called as reinvestment rate. So you invest for 5% today for 1 year, and then after that for 1 year you invest for 7.009 percentage. Okay, or you invest today itself for 6%, both are going 6% for 2 years, both are going to give you the same return. So this is called as break even reinvestment rate. This is the break even reinvestment rate. Okay, now see, now the question is, why have they used bond price equation? Why have they used bond price equation? See, one is this itself you can consider as the bond. Okay, this way also you can compare. Otherwise, there is one more way. So one more way is, if I write this again, this is for 1 year, which is 5%, and this is for 2 year, which is 6%. So now, if this is 100 over here, what will be the present value here? 1 plus 6% raised to 2. Calculate the present value.
88.9996.
88.9996. Okay, so 88.99. Okay. Then similarly, if this is 100, I'm discounting for 5% for 1 year. So how much will it come to?
95.2380.
95.2380. Okay, now 88.99 divided by 95.2380 is what? Just calculate.
Comes to 0.9343.
How much?
0.9343.
0.9343. 0.9343. Yeah, 0.9343. Uh, okay, 0.9343. So that means this bonds price. See, what I have calculated is, this is for 2 years price. I discounted with 1 year's price 95. What I will get is next 1 year bond. So next 1 year bond is 0.9343. That means 93.43. So if this is 93.43, okay, and this is 1. So NIY, present value, payment, future value is 1 or 100. Okay, this is 100. Payment is 0. 93.43 minus IY 1. Just calculate what is the IY coming to.
0.5733.
0.5733. Shravan, you are getting the same answer.
No, no, it's
I'm getting 7.032.
Yeah,
Yeah.
I made a mistake last time. No.
So that is decimal. It will come to 7.003, right? You are getting
7.032, yes.
7.003, correct?
No, 7.03.
Okay, 7.03, fine. So that comes to 7.03, which is, if we take properly all decimal, that 99, what you said, all that thing will match up with this number, 7.009. So that means you can use this method also. These all are bond pricing. So I'll just, quickly say this, explain this once again. Okay, because it looks too little congested here. This is 1 year and this is 2 year. So this is, if I take this as 100, okay, or if I take this as 1 rupee, 1 rupee or 100, whichever you are convenient. So let's say 1 rupee, 1 plus 6 percentage I am taking here, right? 6 percentage, 6 percentage. Just find out the present value here.
0.8899.
0.8899. We'll
Yeah.
go for 5 6 decimal. 0.8899, then
And then again 19
19.
and
Okay,
then
fine.
644.
Okay.
Yeah.
And here it is 1 discounting with, let's say, 5 percentage. This is 5 percentage raised to
Yeah,
1.
so it's 0.952380. Yeah,
Hmm.
it's a big number, 952.
Okay, fine. So that means if I rewrite again, this is, okay, this entire bonds price right now is 0.952380952, and this 2 year bonds price is 0.8899196444. I want to know what will be the price of this bond, 1 year bond. So just like how I was doing before, the interest rates, spot interest rates, spot rate, we were discounting and finding out the implied forward rate. Similarly, how will I find this one? The bigger one, 2 year spot rate, 0.8899196444 divided by, or discounting with the,
It should be
because it
squared,
is,
right?
uh,
The
no, it should
numerator.
not be squared because it is price, no? So I'm not going to
Okay.
even do 1 plus thing, because for interest I was doing 1 plus, but this is price. So 0.952380952. Just calculate and tell me the number.
It is 0.934496
Hmm.
262.
Okay. So that means after 1 year, here this will be the price, 0.934496262. Okay, and the price here at the end will be 1. So based on this, let's calculate IY now. So based on this, N IY present value, payment, future value. Future value is 1. Present value is 0.934496262. Payment is 0. IY 1. Now calculate IY.
Now it is 7.0095.
Yeah,
I won.
okay, which is over here, which we got. So that's why using bond price mechanism also we can find out the rate. This is the rate for the second year. You calculate like this, or you simply do the spot rate that we were doing. Okay, the spot rate is what? This part. You are able to understand this line now. Z means spot rate, 2-year spot rate. Is it fine? This statement is okay.
So this is what they explained, like what we
Ah,
did was
ah,
explained here.
ah. They say, see, since the break-even reinvestment involves a zero coupon cash flow, first substitute 1 year into the 2-year bond price. So substitute 1 year into the 2-year bond price equation to solve the 2-year spot rate. Then set 1 plus 1 into 1 plus break even is equal to. So here also they are, uh, you know, here if I want to use interest rates, how I can use interest rates. Uh, let's say this is 1. Okay, how did I get this one? Acha, I took the interest rate, right? 6 percentage. Okay, but that is not mentioned here. Okay, since the break-even reinvestment involves a zero coupon cash flow, first substitute the 1 year rate into the 2-year bond price equation to solve for the 2-year spot or zero rate. To solve for the 2-year spot or zero rate. So that means uh, again there is no number given here, but that means I have taken the number and I have done on my own. But number, it means this one only. Wait, how do I then further elaborate this? First, substitute the 1 year rate into the 2-year bond price equation to solve. That means for this 1 year, I will consider this is 2-year bond. For this 1 year, if I consider 6 percentage, what is going to be the second year rate? Okay, to solve for the 2-year spot rate. Then set 1 plus R1 into 1 plus break even is equal to. And this is what it means. Now, it can be said in different ways. See, like now this one I did it using bond price way, and this is all through interest rate. Okay. Fine. We'll move to the next one.
Yes,
Is
sir.
it okay? Yeah.
Yes, sir.
Then this one, Baywhite Financial seeks to gain a competitive advantage by making margin loans at a fixed rate for up to 60 days to its investors' clients. Since Baywhite borrows at a variable 1-month market reference rate to finance these clients' loan, the firm enters into 1-month FRA contracts on 1-month MRR to hedge the interest rate exposure of its margin loan book. Which of the following statement best describes Baywhite's interest rate exposure and the FRA positions? Okay, so FRA means what? You are entering into an agreement to borrow at the future date. Okay. Which of the following statement best describes Baywhite's interest rate exposure and the FRA position it should take to hedge that exposure? See, Baywhite Financial seeks to gain a competitive advantage by making margin loans at fixed rate for up to 60 days to its investor clients at fixed rate. So Baywhite borrows at the variable interest rate. Okay, so this company Baywhite borrows at variable rate and lends money lends at the at the fixed rate at the fixed rate for 60 days. Hmm. Baywhite borrows at a variable 1 month market reference rate. So borrow at the 1 month market reference rate to finance these clients. The firm enters into 1 month FRA on 1 month MRR. Okay. So that means every time they borrow from like this, today they will agree to buy uh, after 1 month for 1 month. Okay, after 1 month for 1 month they are agreeing to buy. So the rate will keep changing. So that is the problem. But they are lending money at the fixed rate. So how do they hedge this problem? That means your problem is you are getting loan at the variable rate. So how do you hedge? You have to make it fixed, or you have to push this risk to somebody else. Okay, now let's see. Baywhite faces exposure to a rise in 1 month MRR. Correct? That risk is there, right? If the interest rate goes up, you will borrow at the higher rate, but you have to give at the fixed rate. So the risk is higher. So this is possible. Uh, so this is also possible. Faces a decline in 1 month MRR over the next 30 days, so it should enter into FRA. No, this is not possible because you have a fear that interest rates will go up, and that is why you are thinking about hedging. Okay, the question says you have to hedge this exposure, so it should be between A and B. Till here, is this okay?
Yes, sir.
Okay. Now, Baywhite faces. So, what is the difference between these two? First line is all
The
same.
first one, they're saying that they are borrowing, like
This
they are
is the
the
difference.
payer, right? Yeah,
This is the difference. Payer and receiver.
payer
Rest
and
all are
receiver. Yeah. So
rest
like they
all
are
are same.
first they are taking a loan and then they are giving it to someone
Ha
else,
ha.
is it?
So here, okay. Now the difference is all between payer and receiver. So let's see which one makes sense. So what should they do now? They should be receiving. See here, they are borrowing. That means they are taking. So they should enter into an agreement where they will give floating. That means this floating, and they should receive at the fixed rate. They should receive at the fixed rate. Receive fixed rate. So then what will happen? They will receive at the fixed rate, and then some other fixed rate they are lending. So the business is much safer now, no? So let's see. Baywhite faces exposure to a rise in 1 month MRR over the next 30 days. So it should enter into the FRA as the fixed rate
It's a
receiver. Fixed rate receiver. Fixed rate receiver, no? You should
no,
receive fixed rate, and then that fixed rate you should lend it.
okay. No, like
Because if
the
you
answer is A.
the answer is A, okay.
Yeah.
It should enter into FRA as the fixed rate payer in order to benefit from the rise in 1 month MRR above
Because I
the.
think this sounds better, right? Because so if they think that the are going to rise, so they can fix the rate, right? As payer,
Okay,
like
wait,
what they're
wait.
paying.
In order to benefit from a rise in 1 month MRR above the FRR and offset its higher borrowing cost, should enter into a. You have
Because
your
then
risk of receiving
when they
fixed.
give out loans,
So
they'll
you should
receive
pay
higher
floating.
interest, right, from their clients. Bay White would receive higher interest, right?
Okay, is it not making sense? Uh,
In E,
See, Baywhite faces exposure to a rise in 1 month MRR. Faces exposure to a rise in 1 month MRR over the next 30 days. So it should enter into the FRA as a fixed rate payer.
so
If
like
the
if the
interest rate is going up,
rates rise, right? They'll benefit from like from their clients, right?
if the interest rate is going up, if
Yeah,
MRR is going up, then they will be borrowing here at the higher rate
but then they'll fix it, right?
over
That's
the
what they
next
say.
30 days. So it should enter into the FRA as a fixed rate payer. It should enter into the FRA as a fixed rate payer in order to benefit from a rise in 1 month MRR above the FRA rate and
Like
offset its higher borrowing
in
cost.
A only they'll be able to offset it, right? In B it's not possible, like
How do you say?
because so if the rates are gonna go high, like they'll receive if they receive floating rate from their clients, so they'll receive higher interest compared to a fixed rate of interest, right? And now like they are like fixing an interest what they're going to pay, like a rate of interest. So like they can benefit, right?
Baywhite borrows at the variable rate. They are borrowing at the variable rate. They want to borrow at the fixed rate. Baywhite faces exposure to a rise in 1 month MRR over the next 30 days. It should enter into FRA as a fixed rate payer in order to benefit from a, okay, if they enter as a fixed rate payer, they will pay fixed rate and uh, they will get higher higher floating rate,
Yeah, yeah,
higher floating rate.
yeah.
So they will get higher floating rate.
Like there are three people
Then
here, right? So,
how this will be? They will get higher floating rate.
and they are paying less. Like they're paying a fixed interest.
Okay, so here, how is this wrong? They Bayward faces exposure to a rise in 1 month MRR over the next 30 days. So it should enter into the FRA as a fixed rate payer. So if it enters into an FRA as a fixed rate payer in order to benefit from a rise in the 1 month MRR above the FRA rate and offset its higher borrowing cost. That means they have to enter into another FRA agreement saying like they will pay fixed rate and they will receive floating. Right now they have agreed to borrow at the floating rate. Okay, so yeah, okay, fine. See here how it works is you are borrowing at the variable rate means you are supposed to pay variable rate. Now when you are paying variable rate because you are taking loan and you are paying variable rate, you want to have an agreement where you will hedge. Now how will you hedge? When you will receive variable rate from somebody. So this will work then. You are receiving that variable rate, floating rate from somebody. Okay, this is somebody else. This is Z. You are receiving that variable rate from somebody and you are agreeing to pay fixed. So this way, whatever you are receiving here, if this is 6%, you will pay that to here. Okay, so finally you are paying only fixed rate when you are borrowing. Okay, So this way, this gets nullified. This gets nullified because here you are paying floating, here you are taking floating. So if it is 6, you are taking 6, you are paying 6. If it is 7 percentage, you are taking 7 percentage. Uh, Here you are giving 7 percentage. Okay. So, if this works, now suppose if
So
I
they are saying that they are offsetting it. So what they are paying should be less than what they are receiving, right?
in order to benefit from the rise in 1 month MRR above the FRA rate and offset its higher borrowing. Offset is higher borrowing cost is this one only. This is offset.
So
Now
let's say
if
they
I
are
go
paying
with
6% fixed and they're receiving 7% variable, right?
say it again.
Let's say like they are paying 6% fixed interest and they are receiving from their clients, let's say 7 or 8% as a floating rate. So they're also able to like
No,
pay
they
for
are
the,
paying fixed rate, right? They are paying, I mean, they are receiving fixed rate. They are lending money at the fixed rate. No, see, they are paying fixed rate
yeah.
to borrow, and also they are giving money at the fixed rate to their clients.
Okay, so
Now,
they're not like it is
I
not
think we will just redo. It
floating.
is just we will just redo all this. See, freshly we'll do. See, what it says is after every 1 month they are borrowing. Now, when they are borrowing, right now the deal is they have entered into an agreement to borrow at the floating rate. What does that mean? Borrow at the floating rate means you are giving floating rate interest. You are giving floating rate interest. So then what are you getting? You are getting a loan. And then what are you doing with that loan? That loan, you are giving that money to somebody. Okay, to
But
somebody.
like
That
the
loan
loan
money,
that
let's
I'm
say this
giving
is
to
1 million.
somebody,
That 1 million you are giving it to somebody and you are receiving fixed rate. You are receiving fixed rate. So
but
let's say if this floating is 7 percentage, if this fixed is 8 percentage, you are making 1 percentage profit. Okay. Now the fear is what if this 7 percentage goes to 9 percentage? Then you have to borrow at 9 percentage. That means you have to pay 9 percentage. Borrow means we are normally thinking that money is coming in, but interest is going out. So we have to
yeah.
pay at 9 percentage. When we are paying at 9, but here you cannot change. Here they are saying it is fixed. So 8 only will come. So there is a risk over here in the business. Now the question is how to hedge this risk. So, what are you doing? You are entering into another FRA agreement with Mr. A, wherein you are saying, look, your risk is uh, you have to pay floating. So you are saying, look, you give me floating. Okay. So if you give me floating, that rate they will pass it on over here, and in return he will pay fixed rate. Okay. It should enter into an FRA as a fixed rate payer. Yeah, it is paying fixed rate and it is receiving floating as a fixed rate payer. It should enter into the FRA as a fixed rate payer in order to benefit from a rise in 1 month MRR as a fixed rate payer, in order to benefit from a rise
So this means that they are receiving floating interest, right? If they are to benefit from the like rise in interest. Like,
Fixed rate pair in order to benefit from a rise in MRR above the FRA rate and offset its high borrowing. So yeah, in order to get the benefit means if this interest goes up to, let's say, 10 percentage, so they are getting 10, but they will pay some fixed rate. Say for example, they are paying maybe uh, let's say 7 percentage here. So they have to pay only 7 percentage, and they are receiving 10, and that 10 will be forwarded over here, and from here you are getting the loan, and here you are paying 7 percentage. Okay, it makes sense. Hmm. Shravani, have you understood this one?
Yes, I understand.
Okay. Subhajit, you got it this one?
yeah, sure, I got it.
Okay. Hmm. Baywhite observes that 1 month MRR is 1.2 percentage and 2 month MRR is 1.5. Which of the following is closest to the forward rate that Baywhite would expect on this? How you should read this is after 1 month for 1 month. After
This
one
is
month
quite
for one
easy
month.
actually.
Huh. This is because it is monthly. How you should calculate is, see, normally we would have done like this. If this is year to year, if it is
Divide
two
by
year
12,
and
right?
1 year, this is how we would have done. However, this is not how we should do. If you check, you will get wrong answer. Okay, because why? Because it is year to year we are comparing, but we are supposed to do month to month. So how you should do is 1 plus 1.5 percentage is for 360 days. I will convert it into 1 month, that means 30 days, divided by, okay, 1.2 percentage divided by 360 into 30. Just calculate this. First you calculate this part, then you do plus 1, then you store it. Then you calculate this part, then you do plus 1, then you store it. Acha, 1 minute. This is for 2 months MRR. This should be 60 days.
Do we have to deduct one? Like,
Deduct 1.
so minus one and then into 100, right?
Yeah, yeah.
So it's 0.1498, 0.1498.
Now this is for this gap. The gap means what? 30 days. I want to annualize it. You just calculate, then I will re-explain. Just calculate again now, this much.
Okay. Yeah, so it's
But
1.79. 1.82.
This is 1.8 percentage. Okay. Now, have you understood how I did this one?
Yes, sir.
Okay. So this is 1.5 percentage is annual. So I'm making it for 60 days. How much? Here I'm making it for 30 days. How much? Just like over here, 2 minus 1, we get the answer for 1 year.
So like the
So here,
first timeline would be like for the first month it's 1.2%, and for the second timeline would be first one
not
month
not
1.5%. Yeah, this would be 1.2, and the second one would be 1.5 and 1.5, right?
this much is
Okay.
no. This much is 1.5 converted per annum. This is per annum, which we have to
Okay.
proportionate. This is per annum, which we have to proportionate. Proportionate it to 30 days. The second one, we have to proportionate it to 60 days. Is it okay?
Yes.
Yes, sir.
Okay, what is the next one?
Next module.
What is the page number?
146.
This question.
Yeah, there are four. Yeah.
Okay.
So like, but are we going to get such questions?
No, these are just for practice sake. You are not going to get any case studies also, first of all. Okay,
Okay.
all these are only for practice sake. So now we'll see the question first. Today's copper spot price is 4.25 per pound. Okay. And the constant risk-free rate is 1.875 percentage. Each contract has a $10 storage cost payable at the end of the month. Which of the following statement best characterizes the margin exposure profile of ACE's CTA client if it enters a 1-month copper future contract? Okay. Which of the following statement best characterizes the margin exposure profile of ACE's CTA client if it enters a 1-month copper futures contract? The CTA will be expected to post 10,000 initial margin and would receive a margin call if the copper future price were to immediately fall below uh, 4.10 per pound, below a price of 102. CTA will be expected to post 10,000 initial margin. CTA will be expected to post 10,000 initial margin. Which of the following statements best characterizes the margin exposure profile of ACES CTA client if it enters a 1-month copper future contract? Okay, ACE serves as a future commission merchant to assist several of its commodity trading advisor clients to clear and settle their future margins positions. With the future exchange, ACE is reviewing the copper future market for a CTA client, considering a long copper future positions for the first time. So ACE is reviewing copper future market for a CTA client, considering a long copper future position for the uh, first time. Contract maturities monthly 1 month to 15 months. Contract size 25,000 cash settled. Price per pound. Initial margin 10,000. Maintenance 6,000. Last CME business day of contract month. CME trading operation calculation daily settlement values
What
based
is
on
CME?
published. This is Chicago Mercantile Exchange, where
Okay.
that is an exchange where this derivative contract takes place. Okay, so this copper futures contracts are taking place. Okay, this, today's copper spot price is 4.25 per pound. Okay, per pound. We are entering into the contract for how many pound? 25,000 pound. So 4.25 into 25,000. Okay, and the constant risk-free rate is 1.875. So this is for how many months? It is for 1 month. Okay, just calculate this. How much is this? 4.25 into 25,000.
1062.5.
1062.5.
Yeah.
What 1062.5? This is 25,000. This is 4.25. How can it be 1062.5? 25,000 into 4 itself will come to 1 lakh, no?
Isn't it percentage? Right?
It's not percentage, multiplication.
Oh,
4.25 is per pound. I want
okay.
to
So
know for
one lakh
25,000
six
pound.
thousand and 250.
Okay. So 1,06,250. Okay. So this is the total for 25,000 pound. Plus, see, when you are entering into the contract, this is for risk-free rate for 1 month you are entering into the contract. So 1 month, 1 plus 1.875 percentage for 1 month. That means 1 by 12. Okay. Then plus we are supposed to add the storage cost is 10 payable at the end. Okay. So calculate this one.
So it is 106
Hmm.
414.6058.
Okay. And then they are supposed to pay 10 storage cost. So plus 10. So 106424, right? Plus
So
6058.
only $10.
Yeah, $10. Storage cost will be like that only, right?
So yeah,
Storage cost.
106,424.60.
Okay, this is 606058. Okay.
Yeah.
Now, which of the following statement best characterizes the margin exposure profile? CTA will be expected to post 10,000, 10,000, 10,000, fine, and would receive a margin call if the copper future price were to immediately fall below 4.10. If the copper future price were to immediately fall below 3.80. Okay, but we cannot determine the exact future price at which. Okay, now this is the future price. You are paying 10,000 initial margin. So if you are paying 10,000 initial margin, maintenance margin is 4,000. So if it goes down by 4,000, it will come to 6,000. So if it is coming down by 4,000 here also it will come down by 4,000. So 102, 424, somewhere, okay, 425. Yeah. So I can round up this to 425. So once it hits to this price, the margin money will come to 6,000 and you will get a call. Yeah, that's it. This is the one. So the question is basically, at what price will you receive the margin call? That is the question. So what price they mentioned, it is 6,000. When 10,000 becomes 6,000, okay, you will receive a margin call because minimum you have to maintain this much. So that's why this amount, when it comes down by 4,000, it will be reaching to this amount, and then that time margin call will happen. So minimum this amount has to be maintained. Below this, margin call uh, margin call will happen. Have you understood this one?
So what was that 6,000 thing? Like, yeah.
6,000. See, remember in future contract, how does it work? This is the future price. You have to pay initial margin. Remember
Yeah,
mark to market, I said.
right.
So imagine X is paying 30, Y is paying 30. And when the price is going up, so it is good for Mr. X, let's say
H.
105.
Yeah, yeah,
So plus 5 minus 5.
right.
So for Y it is bad na, when the price is going up.
Yeah.
Okay, similarly, if the price is coming down, let's say 95, then what will happen here? Let's say instead of price going up from 100, it comes to 95. Then it will be
So
minus 5
plus
plus
5
5,
for Y.
minus 5 plus 5. So
Yeah.
then again it comes down to 85. Then minus 10 plus 10.
Uh,
So what is that price when there will be margin call? Margin call means you will get a call from the broker and say, like, let's say it has come down highly. It has come to uh, from 100, it has come to 80 further. So minus 5 and plus 5. Now only how much money is left out from 30? 20 rupees gone. So only 10 rupees is left out, right?
yeah,
He will have from 30, he will have 50. Okay, all this will be 50 plus 20.
right.
Uh, so there will be some price at which you will get a call from the broker and say, like, look, you have to invest more and bring this money up. You have to invest more and bring this money up. Is it okay?
Yes.
That is only we are finding here. This initial margin, see, when this price is coming down, initial margin is also coming down, no? So this is that price
Yeah.
which is coming down. Initial margin is also coming down.
Okay.
So they've already given the maintenance margin at which it will come down to. So we just need to calculate that.
No, just speak little louder, please.
So they've already given the maintenance margin as 6,000.
They have given the, yeah, maintenance margin means, see, initial margin is 10,000. Once it reaches to the maintenance margin, there will be certain limit they must have kept. Once it breaches that one, then the participant, that means Mr. X, has to pay more. It is just like, imagine you have some minimum maintenance margin in your bank, correct? So if it goes down, you will be charged. Okay.
Yes.
Similarly, you can also think like, imagine you are staying on rental basis. The salary, the rent is 10,000 rupees, and the owner is taking, let's say, 6 months rent, 60,000 from you as advance. Now imagine for some reason, first month you could not pay, second month also you could not pay, you requested or whatever, third month also you could not pay. Now what do you think the owner will do? He will keep taking your excuses for 6 months or 7 months, or he will take your excuses for 2 3 months only?
2 3 months only.
Why not 7 months?
Because
Because
then
if Hmm, hmm.
there's a chance that we just won't give the money at all.
Yeah, exactly. Because if it goes to 7 months, then the owner is in your control. You are not in owner's control then, right? Because you
Yes.
owe 70,000, your money is with him only for 60,000, whereas his money is with you for 70,000. So you are more important than at that time.
So
So on
here, like in this
similarly,
sum, sorry.
wait, I'll just finish this. Similarly, that is why he will the fear for him is, as you said, like if it goes for 7 months, he might lose money. Similarly, the fear is what, if tomorrow this 80 comes to, imagine, for some reason 60, then what will happen? Minus 20 plus 20. But where is minus 20? Hardly the balance is 10 rupees only. Then who has to pay the remaining 10? You got the problem here,
Yes, sir.
because balance is 10 rupees. Now it has come to 60. So that's why now the broker has to pay. So broker will say, I don't want to take all this risk. Minimum this much only. Beyond this, you have to pay. That is maintenance margin. Subhajit, what did you say now?
Like in this sum, now, so once it reaches to 6,000 per contract, the holder, like he's long on call, right? So he has to pay 4,000.
Yes, yes, correct.
So like in total, how many contracts are there? Like here the price is 106,424. Right?
How many contracts are there means,
Like
this is only one contract where the lot size is 25,000.
yeah, 25 pounds.
Yeah.
Yeah.
Is it okay?
Yes, sir. Understood.
Yes.
Then next one. One of ACE's investor clients has entered a long 6 months forward transaction with ACE on 100 shares of Shenalia, a non-dividend paying technology stock. Oops, so lengthy question. Here, client realizes ATM and MTM gain of approximately 1,500. Client benefits from an MTM unrealized because ACE has entered a hedge. Okay. One of ACE's investor clients has entered a long 6 months forward contract. Long 6 months forward contract with ACE on 100 shares. One of ACE's client. So that means ACE is short, has entered a long 6 months forward contract with ACE. So ACE is short, the client is long. So client is long. Okay, and short here. Hmm. One of ACE's investor client has entered a 6 months long 6 months forward contract. So this is 6 months forward contract with ACE on 100 shares. Okay, he is shorting 100 shares. We are speaking about the client, no? So 100 shares.
And is the strike price 85.42 euros, is it?
Now the stock price, the stock's spot price per share is 85,
85.
and the risk-free rate. See, this is a 6 months forward. Okay, so that means spot is 85 into 1 plus risk-free rate is
1%.
1 percentage. 1 percentage for all maturity. So this is for 6 months. So this is for all maturities. Okay, so 1 percentage. Just calculate this.
85.85.
85.85.
Yeah.
This is the forward price. Okay. Ace has hedged the client transaction with a long 6 month this future contract at a price of 85.42. Okay, so Ace has become a long over here. Now to hedge. Here Ace is short.
Yeah.
Now the story moves to Ace side. So Ace is long at 85.42.
42. So like what he did, like he bought shares or what?
Huh?
Here he bought shares or what?
Yeah, he is long. He has entered into the contract.
One more
One
derivative
more
contract.
derivative contract. Yeah.
Okay.
He has not bought shares. He has entered into a future contract. So this is
Okay.
future. Acha, this is forward. This is future. So this is forward. And this is future. Okay. And posted initial margin of 1000. Okay. Because this is future, he is supposed to pay margin. Initial margin 1000. And posted initial margin of 1000. Okay. Initial margin of 1000. 3 months after the forward and future contracts are initiated, that is this, Shenalia announces a strategic partnership with a major global technologies firm, and its spot share price jumps 15 euro on the day's trading to close at 123. So 15 days. When is it? No, 3 months after the contract. So this is for how many months future contract? 6 months future. This is also 6 months. So in 3 months, somewhere in between, the price shoots up to 15 plus 15. Just take plus 15. No, it is reaching to 123, not plus 15. It is reaching to 123. Okay, so that means, see here, as a short, Ace wanted the price to go down, and as a long, Ace wanted the price to go up, and it has gone up. So what is the net profit? We'll see that one. Let's see what is the actual question now. Ace's client realizes MTM gain. See, client is in forward contract. Client will not realize gain. Oh, 1 minute, I'll just charge this laptop. 1 minute. Okay. Hello, can you hear me?
Yes, sir.
Okay, I'm not able to hear you. Just hold on.
Hello.
Hello. Yeah, can you hear?
Yes, sir.
Okay. Um,
Screen sharing is off.
yeah, I'll share it now. So client realizes MTM gain of 1500 on the margins account, which ACE must deposit at the end of the day to cover its margin call. So because it is forward contract, there is no mark to market here. So first one is not the one, because client in this margin deposit all they are not going to do.
So like
Everything
in
will be settled at the end only.
because in forward contracts we just quote a price, right? A future.
Hmm?
Like in a forward contract, we can just like quote a price, right? That's why we there's no MTM in it,
Yeah,
right?
there is no deposit
Yeah.
amount, initial
Yeah.
margin or
Like I'll just
600
say a
required.
price that I'll buy it for
It is
a
just an
thousand
agreement.
rupees.
It is an
It's just
agreement. It is just an
not like
agreement.
futures, right? Yeah.
It is just an agreement.
So that can
Okay.
be MTM.
So there is no MTM here. So ACE need not deposit anything. So that is not the one. ACE's client benefits from MTM unrealized gain. So that is possible. Unrealized gain will happen with ACE, and ACE is corresponding MTM gain of approximately 1500. So how 1500? Where is 100 coming from? 100 shares. Okay, 100 shares. So 100 shares into 15 deposited by the exchange. But why only 15? Is it 15? Is it coming? This is much more. Okay. Because ACE is entered into a hedge of its client's forward position on Shinalia by executing a future contract with otherwise identical terms. The two contract MTM values exactly offset with one another and no cash is exchanged. This is not offsetting with each another, nothing like that. So should be B, but benefits from an okay, this is right from that particular day perspective. On that day, it is going up by 15, but overall, it has gone up highly. So out of these three, this is only fitting in corresponding MTM gain. A's clients benefits from unrealized gain, and A's is
Yeah,
corresponding MTM gain.
it's B. Yeah, it's B.
Yeah, yeah. You understood the reason?
Uh,
Overall, it has gone up much high. See, 123 minus 85.42. That is their profit.
eight
However,
thirty
on that day, it is 15 is the profit multiplied by number of
85.4.
quantities. Okay, multiplied by quantity is 100.
Yeah, like I didn't get it. Why it's 1500?
Because on this day,
Yeah.
it went up by 15, right? 15 on the day's trading. So on that day's trading perspective, it is correct. And it is for 100 shares,
Okay,
right?
it jumps by $15.
Yes, and for 100 shares, somewhere it was given here for 100, this one, 100 shares.
So,
Okay.
sir, like in this sum, like they did not quote a price, right? A forward rate for the like on which ACE's investor clients was
No,
long.
this is the forward price,
This is the
because this is
forward price.
spot. This is spot. Risk
Okay.
free rate is given. So the purpose itself is to
So let's
calculate the
say if it's
forward rate.
trading at 123 and minus 85.85, so the difference is 37.15, right?
Huh? Which number you are saying? Say it again.
So it's trading at 123,
Huh.
right?
Huh.
And the rate that they had fixed was 85.85. Okay.
Hmm.
Okay, so it has nothing to do with that, right? 123.
No, see here it has gone to 123. Here also it will go to 123.
But then,
Now in this case, for A's, in this case, for A's it's a loss. Okay. In
okay,
futures it is a profit. Why for A's it's a loss? Because A's is a short in forward.
yeah,
Okay. But the question is, first part is A's client is getting the benefit.
right.
Where is that option gone? This one, no? Which one?
BB is the correct answer.
This one. So client benefits. And second part is A's is corresponding MTM gain. MTM gain means exchange. But
From
they are not
futures.
spoken anything about the short. In short,
Okay,
there is loss only.
okay. So like this is the most sound like
Hmm.
um,
Yeah.
amongst these three.
Yeah. Is it okay? Understood? Okay.
Yes.
Yes, sir.
Two more questions are there. Okay. Should we continue? Two more questions. Should we continue, or you want to do next time? I think you must be going to sleep now, no? So two questions only.
Okay.
Okay, we can do next time then.
Okay, so
Okay,
I
we'll
guess there
stop.
are more like there are I think 10 modules in
Acha,
this.
हाँ. Oh, 10
Like
modules are there
yeah,
like this.
yeah. So there are many more to
Okay.
go.
Okay, fine. We'll stop now only here. Yeah. Acha,
Yes.
tomorrow, uh, tomorrow morning, do you people have time? Like around 10 o'clock, 11 o'clock, 10 o'clock, like that? 10 o'clock morning?
Yes, sir.
Uh,
No, sir.
no?
I don't.
Okay, then we'll connect evening only. Okay. Yeah. Okay.
Okay, sir.
Okay.
Bye, sir. Thank you, sir.
Thank you, sir.